Okay, so what's the next segment? Investment property taxation. Okay, and she started to talk a little bit about it as far as depreciation and things like that. So that's exactly what we're going to talk about. We're going to talk about passive, active portfolio income. We're going to talk about depreciation, and we're going to talk about 1031 exchanges. All right, so whenever we are talking about passive income and active income, so active income is going to be the monies that you put on your name tag and your shoes for and you go and grab, right? That is your active income. Portfolio income, your investments that are making money for you, that is also going to be active and portfolio income. Your passive income is going to be the monies that you are making while you're sleeping, right? The equity and things like that that you're building in your investment. I read an article that Magic Johnson, that every time he goes to the bathroom, he makes $132,000. Yes. I wish I could make that kind of passive income. But so that is an example of passive income, the income that you are not actively working for.
He's a genius of a businessman, by the way.
Yes, he's doing everything.
He was a keynote speaker at an R4 convention about 5 or 6 years ago. He was phenomenal.
Was he actually speaking about motivational things? Because what I saw when I saw him was that he spoke, but he couldn't even get through his speech because everyone had questions about his basketball.
No. Nobody asked anything about basketball. Actually, he was all business.
Oh, that's great.
And he talked about the Starbucks that he opened up actually in Harlem and how he started. And he went knocking on doors, bank, the bank, and 20 banks told him no. Because you're a basketball player, what do you know about running a business?
Yeah.
And he says, well, I want to open up in Harlem a Starbucks, and I want to serve Southern food, cornbread and grits and that kind of stuff, right? And they wanted nothing to do with him.
Oh, wow.
So one day somebody said yes.
Yes. Yeah.
And then later on, he had 10 franchises going. He had everything going.
Right. Well, I think people would pay double for Starbucks if they knew they were buying it from Magic Johnson. Yeah. But yes, perfect example of passive income and then how you can turn it into active income. Okay, so real estate losses, right, are going to be considered passive income. So once again, driving back to your Schedule E. So, 2 types of passive income activity: trade or business activities with no material participation, meaning that you're not actually selling anything or retaining any kind of product. Rental activity, unless you qualify as a real estate professional. Now, real estate professional does not mean real estate agent in this arena. It means someone that for the most part does not work and acquires the majority of their income through real estate investments, but not necessarily that they have a real estate license. Am I right here? Yep. So that would qualify underneath passive income, okay? And they put this wall of separation here just to show the distinction between the two.
Of course, that has a crazy definition, number of hours of work and all of that.
Exactly.
Participation. And all
Yep,
that.
exactly. There's a
The
huge calculation to go
IRS
into.
requires it to be 90% of your income for us.
Yes, exactly. 90% of your income.
Right? I mean, that's
Basically.
what they taught us in the brokers. Yep.
Okay, so the way that it works is that if you have $10,000 of interest on an investment property, so you're paying a mortgage on an investment property, but you did not claim that you paid or that you collected any rents, okay, then you cannot deduct the mortgage interest, okay? An example, let's say that you have an investment property. Let's say that you had proper problems during COVID and they didn't pay for an entire year. And then when your CPA says, how much rent did you collect last year? You say, well, it was COVID. I didn't collect anything. They didn't pay me. The government said they didn't have to. I collected 0. Guess what the CPA told that homeowner? Well, then now you can't deduct anything from that property.
Right.
So they got hit twice. They didn't get the rent and they can't deduct anything on that property because technically they didn't even bring in 1 penny of income, right?
You have to have the income to offset the loss.
Exactly.
Or the deduction.
Yep.
If you don't have the income, you can't.
You cannot take a deduction. So the smartest thing would have been for that homeowner to say, well, they paid me January.
They paid
But
me
then
$5
after
a month.
that-
Or go into forbearance and
Right.
then you're home free.
Right, except then that affects your property, your ability to
Well, we're not
refinance
talking
and
about
all
all
the
that.
other stuff.
You know
Yes.
what I'm saying?
But this is for the IRS, okay? So that was a way that COVID double whammied, right? The
Wow.
homeowners
Wow.
that weren't getting
Wow.
tenant
Yeah.
rent either, right?
Wow.
So
Did you move into it and just say that that was your office for the year?
you could, but did you collect rent is what they're talking
You'd
about.
have to be a corporation
Yeah, yeah.
and you'd have to
An
pay
LLC.
rent.
Yeah.
Do you think they
I
would
wound
be
up doing
Contact
that.
your,
Yeah.
contact your CPA.
That's right. But conversely, okay, if you paid the mortgage interest and if you said, oh, well, the forbearance on my rental didn't start until March or 5 months out, I did collect 10,000, then they could offset each other. But the reality of it is, just like she was mentioning, in the event that you don't claim any income at all, then you cannot deduct anything. So that is what this means. Okay, depreciation. Tax deduction for the value of real estate improvements. What is a real estate improvement?
Remodel?
Just remodeling? So the definition of real estate improvements is the property
Anything on
on
the
top
land.
of the land. So when we have an appraisal performed, okay, if you go to like page 4, there's a little box, and if you have run into this with your clients, with insurance or something like that, the insurance company and the lender is always after the replacement value, right? Where do they get that figure? They get the figure from the appraisal. That is where the appraiser breaks out how much, if it's $1 million home, how much of the $1 million is made up by the land and how much of the $1 million is made up by that dwelling, right? And that's why also when you've got a really dilapidated property and they're calling it a tear down, what will they say? We're kind of buying it just for land value,
Yeah.
right? Because the built structure is worth nothing. Here in Hawaii, we have a very different phenomenon. Across the nation, the land is worth nothing, and the house is worth $750,000. When people come to Hawaii, they're blown away because the home dwelling and replacement value on $1 million house. I mean, we just had one the other day. The replacement value was $337,000 for $1 million home because the rest of the value was in the land.
It's gold.
Dirty.
Yeah.
The land is gold.
Exactly. So, so when we are talking about real estate improvements, it does include the renovations, but we're talking about everything, the structure on top of any of the land, okay? Now, when we are dealing with depreciation, they are not going to take into consideration the land because the land does not depreciate. It doesn't move. You could have a huge fire, but guess what? The land's going to come back by itself, right? And depending upon what's happening in that neighborhood or what have you, the reality of it is it's only the homes that depreciate. The improvements are like a car. It just gets older and older and older, right? But the land is what appreciates. The property itself, or the dwelling or the improvements, is what depreciates over time and needs repair, okay? So in this example, $300,000 purchase price, 75% of that would be the land, and then $225,000 would be the improvements. As we know here in Hawaii, that would probably be flipped, okay? So step number 2, annual depreciation, $225,000 value of the improvements, divided by 27.5 years. So this is the number that the IRS came up with. I do not personally know how they came up with that number. Do you know?
How they came up with
The
number of years.
27.5 for the calculation.
Well, back in the old days, depreciation was based on 30 years, and then they went into a declining kind of depreciation scale when they developed makers back in the 80s. And then they came up later on with a new depreciation schedule, and they decided that 27.5 was the true life value of
Improvements.
Improvements.
on the home.
Okay.
And
Okay.
that was
Commercial is like-
something that they estimated would be until the house just literally fell apart.
Fell apart. Exactly. Exactly. That's great. Thank you for sharing that. And if you look on your appraisal, that's one of the other things that the appraiser needs to notate, right? What is the economic life
Expectancy, so to speak.
of this particular dwelling, right? And if he says less than 30 years, guess what? You're not getting a 30-year loan because the home needs to be standing as long as the loan is given. Okay, so that's one of the things. So this number, 27.5, doesn't have anything to do with you or me. It is an IRS calculation. Your CPA will just plug that in based upon what she was just telling us about how it is based upon what they decided will be the economic life at the IRS level. So in this space, $8,182 would be the annual deduction or depreciation of this particular property. Okay. Total depreciation. So in the event that you have that same calculation from the previous screen, 8182 depreciation, they held it for 5 years, okay? Their total depreciation would then be 40,910. Going back to adjusted basis, so you've got 300,000 in original basis, then you're gonna remove or minus out that total depreciation, so that it gives you 259,090 as an adjusted basis after depreciation, okay? And then this would be your taxable gain number. So $450,000 sales price, 27% cost of sale, and it could be the 6% here, but remember that includes everything that went into the sale, including escrow, all of that other stuff, so that number could be more. And then you deduct out, and then you deduct out your adjusted basis. So now your taxable gain is 163,910, okay? All right, now we get into recapture, okay? Because even though you depreciate your property, a portion of it is recaptured, okay? And it's recaptured at 25%. So 40,900 taxed at depreciation. And then the recapture rate would be 25%. If 123 was taxed at capital gains rate, then you've got 15%. So once again, this is just, they're using 15% based upon your tax bracket, once again, okay? But what you want to remember from this is depreciation is recaptured. It's not free money. All right, 1031 exchange timeline. So, so as we all know, 1031 exchanges can be done in a forward fashion, and they can be done in a reverse fashion. The one that we are most familiar with is the forward fashion, which is sell your property. You have 45 days to find a replacement, meaning that you have to identify at least 3 properties and enter that information into your escrow facilitator. So for everyone that has not done a 1031 exchange, remember most of the title companies will have a 1031 exchange office facilitator. It's not the same escrow officer that you usually work with though. It will be someone else. And they are a separate entity, but they will be, like Old Republic has a good one, right? Julia, most people like to use her.
She's the best.
Yeah, she is the best. And I've also been to her classes. She's really good.
She's fantastic.
Mm-hmm. But anyway, you've got 45 days to find a replacement property, and then you must close on your new property within 180 days. So I was teaching this class a couple of years ago, and there was a gentleman sitting in the class, and when I went over this timeline, he said, well, that's not true. He said, I've been in a 1031 exchange with my client for over 2 years. And I was like, when was the last time you talked to the facilitator? And he said, well, they didn't call me or anything, so I assume that we're still in the 1031 exchange. And I was like, you're not, and you need to go call your facilitator. So next thing you know, he had to leave class. He was in the hallway, going on and on and on with his buyer, because right at that moment, he realized that he was no longer in a 1031 exchange. And not only that, but that his advice had been hurting his buyer because they hadn't done anything with the money or anything like that. They didn't do anything.
Usually Julie would intervene and say, got DSTs available, we're running out of time, let's just move it into DST.
Mm-hmm.
Oh,
We don't know what happened to it. I don't think that he was using Julia, but
I doubt it.
right at that moment,
Was it
right,
even
is when he
using a third party?
realized. I think they were using a third party, but I don't know who they were using. Yep. But right at that moment was when he was like, wait a minute, the light bulb went off. And then he was in a lot of
shine on him.
exactly. And he was in deep water after that. He
Thank
couldn't
God
come
he
back
has
to class.
liability insurance.
All right, so this is a forward exchange, okay? Now, you can do a reverse exchange, meaning that instead of selling the property first, you find a property to buy, and then after you buy that property, you go, so what happens is when you do that, okay, is that the title to that new home that you just purchased that is affiliated with the exchange is not in your name. It is held in the facilitator's name.
Oh, okay.
Yeah. And then once you complete the 1031 exchange on this side and you find your new property and then you buy that, then they will transfer title to you. Okay. Now you can perform a forward 1031 exchange by using a loan because you're taking title. When you
Use a
are
bridge loan?
performing a reverse. When you can use a bridge loan, you can use whatever kind of loan you need at that time. Bridge loans have a fancy name. Most folks don't want to use a bridge loan. They're 12 months. You multi-collateralize the properties, and then they put a mortgage on all of the properties all at once, and then generally you have a much higher interest rate for 12 months. It is a very risky transaction. Most folks will not opt for that, especially if you have another way to get there. And the other way to get there, and I think, Damon, you mentioned this earlier, is to get that home equity line of credit, right?
So
If
that-
you need money.
That doesn't apply to the usury laws then?
What do you mean by that?
A bridge loan, it doesn't have to be under the usury 13% or whatever it is now, 12%.
You mean
Is
the
that
interest
to say
rate?
private?
You mean the interest rate?
Yeah.
Yeah, the interest rates for a bridge loan are usually, especially right now, they're usually about 8 to 10%.
Oh, okay.
Yeah.
So they're not
It's-
that crazy?
No, they're not that crazy. But what it is it's the risking, right, of the
The
bridge
wrapping
loan
of all
and
the
wrapping
properties.
everything together. And we had a very real situation like that, meaning that I was working with a customer and she was trying to sell her home at the cottages at the peninsula. And she was engaging in this 1031 exchange, and then the big litigation came down. And nobody could get financing on on the property she was trying to sell, and she had to pull out of the 1031 exchange because the reality of it is it did not look like she was going to be able to get a seller in time because of the financing issues going on with that project. So that is a very real situation. We were entertaining a bridge loan for her at that time. If she had engaged in it, she would have been liable for that whole thing regardless of how it all panned out for her or what was happening over at the peninsula. Right? So it is very risky. I am very familiar with bridge loans. But I have not, and I've pitched a lot of them, meaning that I've spoken with a lot of clients with them, but I've never actually had anyone pull the trigger on it because of the exposure that you're at and the risk that you're at and the short timeline. So, and the fact that it wraps the two properties together and your mortgage is now encumbering of both of those, right? When you're performing a forward 1031 exchange, you sold this property, you're out of that debt. But when you do a bridge loan, you're carrying both of them.
Right.
So if you thought that a $5,000 mortgage was scary, now think about a $12,000 mortgage, that you've got to perform on this timeline, and you've got this lender breathing down your back. So here in Hawaii, most folks will not do that. They will opt for the home equity line of credit, so that way they can extract the monies as they need, leverage their equity, do all that stuff without the bridge loan. But they're still out there, and they are also called cross-collateralization loans. But they are very risky. They are very risky, and the payments can be very substantial and hard to swallow for the average homeowner. So when we do when we do a forward mortgage, you're taking title right away because you sold your property, you're buying the property. So a mortgage lender will work with you on that, okay? When you are dealing with a reverse, however, when you purchase that new property, because you haven't sold yet, the title goes in the facilitator's name. And because of that, most lenders will not allow you to have a mortgage at all. They will not lend on that. It's not in your name. excuse me, is not in your name. So generally when people are performing reverse mortgages, they're reverse 1031 exchange, they're doing it with cash, which is why generally we don't hear about the reverse 1031. We only hear about the forward 1031 because most investors also want to leverage their cash, right? And that's leverage the loan scenario and their borrowing power with their cash. And that's actually something that we go into very deeply in the investor class. All right, next one. Why pay taxes? Okay, so in this instance, remember we're dealing
No choice.
yeah, we're dealing with this scenario: 200,000 in capital gains, and then now you've got the 37,500 in taxes. So the 1031 exchange, there's no limit on the times you can use it, but they're going to change that. Okay. Heirs receive a step-up basis. So if you perform a 1031 exchange, you do pass away, and then it passes. Just like the estate law that we talked about earlier, your heirs will receive a step-up basis. I don't know if they're going to change that or not, but I know that they're going after 1031 exchange as a whole, so I know that it's getting ready for a ton of reform. 1031 exchange is ideal for long-term investors. You can use a 1031 exchange to diversify into many, and you can use it to consolidate many into one. So what that means, remember, 1031 exchange is, they always use the term like to like property, right? But basically what that means is investment to investment. And as we talked about our definitions, you cannot have lived in it for the last 12 months. You have to have rented it for the last 12 months or used it as your investment property for the last 12 months. You could even call it your office and have your LLC rent it from you, right? But as long as there is that separation, you could call it technically an investment property because you did not live in it as your primary residence or your vacation home. But you also have to buy higher at or higher than what you're exchanging. So if you are selling your property for $800,000, you have to buy $800,000 or more. Okay? If you do not do that, because I did have a situation where that happened. Son and mom went in on a property together. They did a 1031 exchange. Son wanted to take his money out so that he could go buy a primary residence for himself because he invested with his mom to make a bunch of cash. And mom went into another property, into another investment property. So her portion was then extracted, calculated out. She used it in a 1031 exchange. His portion was pulled out, taxed if he met, based upon his capital gains and whatever he had, in order to buy his primary. Okay, so you can split it out that way. So if you can buy lower, it doesn't mean that you cannot. It just means that whatever you do not use is going to be exposed. And the purpose of the 1031 exchange is protection. Okay, but with that being said, you can sell a house, right, for $800,000 and then go buy 2 condos for $400 each. Or you could sell 2 condos for $400 each and go buy one $800, but it has to be that same price point.
Right.
Yep. Okay. All right. Real estate rental income. So one of the good news is in the, after all the bad news, give you just a little bit of good news. And I think you do have the handout in this one. This is the one where we were confusing it for the previous one. But the old prior to reform was that real estate rental income was taxed up to 39.6%. Now it is still taxed at the 39.6%, but it can come with up to a 20% deduction based upon how your CPA strategically lays this out for you, which ultimately then makes it more attractive to invest in real estate. Okay, so there is a little. So when you're renting, when you're selling, they're going to hit you to the hilt. But when you are renting, there are some specific calculations that your CPA can perform in order to maximize your deductions when it comes to rental income as well. But what I can tell you is just as soon as they reformed it, they are looking into this as well. So we shall see where all of this is headed with 2023. But as of right now, 2022 is your golden year to utilize some of these additional deductions when it comes to rental income. All right, so here's an example. So the way that would work is, let's say that you bring in $10,000 in rental income. Previously, you would not get that 20% deduction, okay? But now you can take up to a 20% deduction. That would reduce your overall income that you received, and then you would be taxed on that appropriately. So if it drops you down into a little bit lesser tax bracket, then that's where it would show you a little bit of return. Now remember, like they talked about earlier, even though it's a deduction, they kind of call it like a little coupon that you apply towards your tax bracket. So it's not a dollar for dollar exchange per se, it'll feed into the calculation itself. Okay, so let's look at investment property calculator, which is another handout that you guys have in there. Okay, here we go. Okay, awesome investor, 8910 Iea Street. I don't know why I chose Iea, just kidding. Okay, so now this is one of our case studies, but if I had $1 for every time an investor asked me, how much do I need to put down? Is it better to buy it in cash? Is it better to put down 20%? Is it better to put half down? What is it? Okay, we're gonna answer that question right now. Okay, so let's go ahead and move on. So, awesome investor. So if you look at the first 3 tiers, you've got cash, you've got 50% down, and you've got 30% down, okay? So value of the property, $900,000. The first one, down payment, is 100% because you're paying all in cash. The next column is 50% down, so your down payment's gonna be 50, and then after that, 30% down. The next line item, mortgage balance, obviously cash, no mortgage balance, 50% is $450, and then 30% is gonna be $630. And then, because you're an investor, you're not gonna get 7.125, you're gonna get something like 7.5 or 7.75, depending upon what you're looking at, okay? Assuming that you've got 30 years, assuming that you've got 30-year loan, this would be your mortgage payment. So $3146 on 50, and $4406 for the lesser down payment. Points, same thing like we talked about with mortgage reform and interest rate reform. Previously, you may have been able to get away with an interest investor loan with 0 points, but not anymore. You're going to be paying points no matter how you look at it when you are an investor. Closing costs, that would be your escrow stuff and additional monies that you would put in. So cash obviously is going to be less than if you were using a mortgage loan. And then total points and costs, so that's kind of a summary of the points and the costs that you're paying throughout this. And then we're going to take into your monthly taxes and expenses, which is the $750 for property taxes and homeowners insurance. And then let's say that this $900,000 home in Iea rents for $4,000 per month. Okay, so that's all of our premises. Now,
Judy, I had a quick question for you.
Yes.
You and I talked about this briefly, but say, you know, on the sales expense, like when we go to close and it's like our kid or whatever, and we're gifting like our whole 3% or 2.5%, whatever the sales side is, where do we put that in the net sheet?
where would you put that in the net sheet?
For an investment like this, like where do you itemize that?
So if you are helping your,
Like my son.
if you're helping
that I
your
sent here to you.
son buy an investment property,
Right.
and then you are gifting him some monies.
Yeah.
Okay.
But it's just like literally what I would be getting in commission just goes directly to him. So
Mhm.
it doesn't even show as income to me. It goes directly into his equity or whatever we're calling it.
Okay, so in that instance, actually, we were buying a primary residence for him.
Right.
Yep, so, and as far as you gifting his your commission, so we are going to cover that in just a second.
Oh, okay.
So gift tax, okay, there's gift tax, and then there's 2 buckets when it comes to gifts. There's gift tax, and then there is your lifetime exclusion gift tax. And we do have a bunch of slides on it coming
Oh,
up
okay,
shortly.
because
Yep,
I just wanted to see like where this
so
debits and credits on the income taxes Like, do I show it as income, or is it never touches my hands, it doesn't count?
So it would be considered income to you because your company technically is depositing it into your income stream. So it's still gonna be
Like a
income for you.
1099.
Yep, it's just that you gifted it to him through
Right.
the transaction. So
Okay.
that would fall under the gift tax.
Okay.
Yep, and
Okay.
then we're gonna cover that in just a few minutes.
What about if you give them a credit towards closing costs through escrow?
That would be the same thing.
Same thing?
If it's your commission, so what she's speaking about is commission. Is that she took her commission, which she earned, which Remax is gonna put on her 1099, okay? But she gifted it to him through the form of a gift letter for lending purposes so that he could pay for his closing costs. We're gonna cover all of this in a few minutes, okay?
Sorry.
Yep.
Yep, decided to hijack the meeting.
Yeah, no worries, no
Sorry.
worries. Let's get through this and then we can get to the gift tax, okay? Because that's one of the next things on the list, okay? All right, so let's go through how this affects your client, because what we're talking about now is how much does the investor need to put down in order to maximize his efforts, okay? So whenever we talk about investors, we always talk about internal rate of return, or the IRR, okay? So let's look at our assumptions again. Let's take a rate of appreciation of 7%. We're gonna make him hold this for 10 years. So when he sells the property, so he bought it at 900, so when he sells it in 10 years, it's gonna be that 177,436, that's the number. And then his sales expenses are gonna be 8%. And then we've got, so that's the dollar amount of the sales expenses. Then he's got his mortgage payoff. So the net proceeds from the sale is gonna look like this under here, okay? So now let's look at our boxes to the right and see how that affects our investor. So, the first box is the cash that he needs to close. Obviously, the 30% down is gonna be less than any of the others because he's putting down less down payment. But look at what happens to his cash flow. So when your investor says, how much do I need to put down? Just 20%? Well, to meet the loan. But is that gonna make him break even? Or is that gonna put him in a deficit? So in this current market, with the current interest rates, where before they may have been able to get away with 20 or 25% down to break even or have a small loss, today's market requires 50%. And that's gonna be a marginal profit. And that's assuming you don't have any repairs, you don't have forbearance that hits you with COVID, you don't have any of that other stuff. So when your investor says, how much do I need to put down to break even? It's probably gonna be somewhere around 50% in this current market. And because you went to this class, you don't have to break out your calculator. You can just say, I learned that we need 50%. But look at this, and this goes back to leveraging what we were talking about earlier with 1031 exchanges and how investors love to use mortgages. For the most part, a lot of folks in Hawaii like to pay cash, but for the most part across the nation, investors love to use mortgages because then they can conserve their cash and they can leverage. But even though they're at a loss here, which they can deduct on their Schedule E, right, and still get some of that benefit, but the IRR is actually higher with the less money they put down. So, same thing, you can look your investor in the eye and say, if you want to break even, put down 50%, and guess what? Your IRR is going to be better than if you pay cash anyway. And then what that does for you as a real estate agent is instead of him spending 100% of his cash on one property, you can get him to put 50% down on this one and 50% down on this one. So now you've got two sales. And eventually, or two purchases, and eventually you've got two more sales. And if you can show that investor how to keep leveraging his cash and making money, he's gonna keep working with you to buy more houses and sell more houses. So this is a very powerful comparison. I actually love this one. I use it all the time for my investors.